Did you know the US is sitting on a ticking time bomb? No, it's not what you think, it's our national debt. Financial expert Jim Rickards believes that a full-blown debt crisis is looming, and the scariest part? No one seems to be talking about it. This could affect your savings, your investments, and the entire US economy. So, what's really going on and how can you protect yourself? Hey everyone, welcome back to the channel. I'm your guide on achieving your financial goals, and today we're diving into a serious but overlooked issue: the US debt crisis. Jim Rickards, a top economic advisor and best-selling author, has been sounding the alarm, warning that our debt-to-GDP ratio is spiraling out of control. In this video, I'm going to break down what Rickards has to say, how inflation and debt are tied together, and most importantly, how you can protect your financial future.
This is about the most indebted period in the history of the world. I never thought I would see so much debt so quickly as we have seen in the last few months. So what we're really talking about is government debt, because no one expects governments to go bankrupt, although we all know that occasionally they do default. We've seen many cases of that, but certainly not, the United States or the UK or Spain or France. No one expects any of those countries to default anytime soon. But the way I think about that is I use the debt to GDP ratio, because debt is not automatically a problem. It may be a problem or it may not be a problem. It all depends on how much income or output you have to service the debt. So just to give a simple example, let's say you have a credit card and you have a $50,000 balance on your credit card. You owe the bank $50,000. Is that a problem? Well, if you make $20,000, it's a big problem. You're probably going to go bankrupt. But if you make $200,000, you could probably, write a check and pay it off. So the answer as to whether the debt is a problem or not can only be thought about in relation to your income. And so I use the debt to GDP ratio. I say, how much debt does a country have? How much debt is outstanding? And how big is their GDP? And when you use that ratio, if you're at, say, 30% or even 40%, that's a comfortable ratio. Yes, you have some debt, but you also have, say, a strong economy and your ability to service the debt by collecting taxes or other sources of revenue is very reasonable, and that debt level is sustainable. But when you get up to 60% happens to be the level under the Maastricht Treaty where the members of the European Union are not supposed to have debt in excess of 60% of their GDP. Now, many of them do. I'm not saying this is a hard and fast rule, but that's where Angela Merkel gets a little bit upset when you're above 60%. And Spain and France and some other, Italy certainly, are above that threshold. But there's another threshold that's important, which is 90%. And 90% comes out of the research of Ken Rogoff and Carmen Reinhart. And what they've shown in developing markets, developed markets throughout the 20th century, recently, in the distant past, no matter where they look, once a country gets above 90% debt to GDP, a couple things happen. Number one, debt is no longer productive. The idea of borrowing is I'll borrow $1, I'll spend the dollar, but I'll get $1.20 of GDP because, I'll spend it on something, but then the recipient, he'll spend it, and then someone else will spend it. And by what's called velocity, or the turnover of money, you'll actually get more than you borrow. That's Keynesian economics, very simplified version of it. But what Rogoff and Reinhart have shown is once you get past 90%, that's no longer true. You borrow $1 and you spend $1, but you might only get 90 cents or 80 cents of GDP. In other words, you reach a point where you cannot borrow your way out of debt. You cannot borrow your way to get enough productivity to get out of debt. And then you're sort of in a doom loop or a death spiral.
Let's start with the numbers. The US government is drowning in debt, trillions of dollars worth of it. To put it in perspective, our national debt is now higher than the entire US economy itself. This is measured by the debt to GDP ratio, which compares the total debt to the country's gross domestic product, or GDP. Right now, the US debt to GDP ratio is over 120%, meaning our debt is 20% larger than the entire economy. That's a level we haven't seen since World War II. But here's the catch. Back in the 1940s, the US was coming out of the war and the economy was booming. Factories were running at full capacity, jobs were abundant, and new industries were emerging. The debt we took on back then was manageable because of the rapid post-war growth. Today, though, it's a different story. Instead of an economic boom, we're facing stagnant wages, slow growth, and rising living costs. In fact, wages for many Americans haven't kept up with inflation, and things like housing, healthcare, and education are becoming more expensive. So, unlike the post-war era, We're not growing fast enough to outpace this enormous debt. It's as if we're trying to climb a mountain, but the higher we go, the steeper it gets. And this isn't just an abstract problem for economists to worry about. When the debt gets too high, it puts pressure on everything from government services to taxes, to the very stability of the dollar. Jim Rickards argues that if this trend continues, we could be heading toward a serious debt crisis, with the US potentially defaulting on its obligations. That's when things start to get really dangerous. But that's not the only danger. Rickards points out another major risk: inflation. When a country is buried in debt, the easiest way out is to print more money. But here's the catch: printing more money leads to inflation. The more dollars that flood the market, the less valuable each dollar becomes. Think about it. If the government keeps printing money to pay off its debt, it's like creating money out of thin air. On the surface, it might seem like a quick fix. Just print more dollars to pay off bills, right? But there's a huge problem with that. The more money in circulation, the less each dollar is worth. And that hits your wallet directly. Here's how it works. Imagine you've been saving up your money for years. Maybe you've been putting it aside for a house, college tuition, or even just retirement. But if the government floods the economy with more and more dollars, the value of that saved money starts to shrink. Your savings may look the same on paper, but in reality, it buys you less and less over time. That's inflation. It's like trying to buy groceries with monopoly money. Sure, you've got stacks of bills, but the store clerk won't accept them because they're worthless. In the real world, inflation works the same way. Prices for things like food, gas, and housing keep going up, but the purchasing power of your dollars doesn't. It's a hidden tax on everyone, especially on those who have worked hard to save responsibly. Jim Rickards calls this the ultimate trap, the inflation trap. Once the government starts down the road of printing money to manage debt, it becomes harder to stop. Every new dollar printed devalues the dollars already out there, and over time, it erodes the entire economic system. For the average person, that means your paycheck may not stretch as far as it used to. What costs $100 today could cost $150, $200, or even more in just a few years. Do you feel the pinch of inflation already? Let me know in the comments below. What everyday items have you noticed getting more expensive? So, how can you protect yourself from this looming crisis? The good news is that Jim Rickards has a strategy. He recommends shifting your investments into assets that aren't easily affected by inflation. Think about things like gold, silver, and other tangible assets. These are different from paper money, stocks, or bonds, which can lose value when inflation hits. Historically, tangible assets like gold and silver have held their value, even when paper currencies became practically worthless. Let's break it down. Gold has been a safe haven for thousands of years, long before modern finance existed. It's universally recognized and holds intrinsic value. When economies falter, governments collapse, or currencies fail, gold remains a reliable store of wealth. And here's the thing: investing in gold isn't just for the ultra-wealthy. You can start small and gradually build up your portfolio. The key is to think long-term. And it's not just gold. Silver offers another great option. It's more affordable than gold but still provides a solid hedge against inflation. Silver is also used in industries like tech and manufacturing, meaning it has demand beyond just investment purposes. As the economy changes, that demand could help silver hold its value. Rickards also emphasizes diversification. That means not putting all your eggs in one basket. In addition to precious metals, consider investing in real estate, another asset class that typically holds value over time, especially during inflationary periods. Unlike paper currency, land and property have real, tangible worth. Plus, they offer the potential for rental income or long-term appreciation, making them a solid part of any diversified portfolio. The goal here is to prepare for the worst while hoping for the best. No one knows exactly what the future holds, but by investing in inflation-resistant assets, you're protecting your wealth from being eroded by rising prices. It's all about thinking ahead and taking action now before the crisis hits. But what do you think? Could we really be heading toward a debt crisis, or is this just another economic scare? Let me know your thoughts in the comments. I'd love to hear what you have to say. And hey, if you found this video helpful, give it a thumbs up and don't forget to subscribe. I've got more videos like this one, breaking down complex economic issues so you can stay ahead of the game. Hit that notification bell so you don't miss the next one. Remember, preparing for a potential debt crisis isn't about panic, it's about planning. Jim Rickards says it best: stay diversified, stay informed, and most importantly, stay calm. You've got this. I'll see you in the next video.